Gas Conference in Denver, Colorado. Joining me now is Jeff Ventura, President and Chief Operating Officer of Range Resources. Good morning, Jeff.
Good morning.
Now, in your second quarter results, you reported production results that exceeded the high end of your guidance. What factors contributed to your success, and what will drive results in the back half of 2011?
We had great drilling results in both the Marcellus Shale and in the Mid-Continent areas. And in particular, in the Marcellus Shale, we exited last year at about 200 million per day. This year, we're expecting to exit at 400 million per day. And at the end of 2012 at 600 million per day. We think with the position we have there, we'll be able to post great results for years to come.
Now in April of this past quarter, you closed on the sale of your Barnett Shale properties. How are you redeploying the capital generated from this transaction?
We've taken the capital and we're putting it primarily into the Marcellus Shale. We've posted on our website a couple of reports, one by Goldman Sachs and one by Credit Suisse. And both show that the Marcellus Shale, if you look at all the gas plays or wet gas plays in US or in Canada, has the best economics of any of the plays. Actually, even if you compare it against some of the oil plays, the Marcellus still might be number one or number two. It's right up there. So we've taken that capital, redeployed it into the Marcellus, and specifically when we sold the Barnett, we were producing initially when we announced it about 120 million per day net. We'll make up that production literally within 2 quarters. So we'll be redeploying it into a higher rate of return project with more upside and more repeatability that will drive results for a long time to come.
At previous conferences, you had described the Marcellus, Upper Devonian, and Utica shales as a triple play. Can you talk greater detail about that and how your shareholders might benefit?
Yeah, when you look at those 3 plays in particular, it's rare. You know, when you look at the Barnett Shale, really there's just that one horizon in that basin, and most of the shale plays are like that. The Appalachian Basin's a little unique in that you can stack literally 3 shale plays together if you're in the right spot. And that's it's the Marcellus, above it is the Upper Devonian, and below it is the Utica. And they all have great potential, and in particularly, if you're in the western, southwestern part of Pennsylvania, you can put all 3 on top of one another. It doesn't happen everywhere in the basin, but it does in that particular region, and we have a big acreage position there. Range today is about, post-Barnett sales, about a 3.5 TCF company. We have upside of 40 TCF to 56 TCF, so we have the opportunity to grow our rates and reserves on the order of 10 to 15 times from where we are today, in one of the best rate of return plays, or some of the best rate of return plays in the country. So great upside, and in particularly of that upside is included 1 to 1.6 billion barrels of liquids, so there's a big liquids component to it too.
Now what are the economics on your project, and what is your outlook on oil and gas prices, natural gas prices?
Yeah, my outlook's probably no better than the market. I mean, that's a very tough thing to predict. If you look at the 10-year strip for gas, it's pretty much between $5 to $6 for most of the time. Oils goes from 80 to over $100 a barrel. So I'll stick with the strip. If you look at the Marcellus Shale, our wells there average 5.7 BCF for a 2009 and 10 program. Cost us $4 million to get 5.7 BCF. But really important, out of that 5.7 BCFE of gas, it's 4 BCF of gas and 281,000 barrels of liquid. So with the strong liquid component, given the cost of $4 million to get that, the wells are only 6,500 feet deep, generates really strong rate of return at that strip, 10-year strip pricing. You're looking at rates of return over 100%. Our horizontal Mississippian play in northern Oklahoma, you're spending 2.9 for the well, another couple $100,000 for water disposal, so 3.1 million to get on the order of 485,000 barrels. At strip pricing on oil, again, that generates over 100% rate of return. Our initial results in the horizontal St. Louis play are actually even better than that. So we have really strong rate of return projects at very reasonable pricing.
Okay, well Jeff, it's been a pleasure talking with you today.
Thank you.
I'm Quinn DeWin for oilandgas360.com.